good morning, everybody, and welcome to the Happy Investor Saturday seminar session, our web series on various aspects related to finance, and hope we will have an interesting Saturday session. We are here today with something that impacts everyone. Everybody is part of that system and has to be compliant with it as well. So here we are today in the tax season with some nuggets and basic information that anybody who is an income earner and subject to income tax should know. So shall we start with the first session? So welcome to our Saturday web series on income tax rules. We also welcome all our online guests who are watching us on our YouTube link. And we hope this would help you to understand Indian income tax rules a little better. So the latest on income tax rules, a guide to income tax rules before the due dates that happen to be end of this month. So who needs to file tax returns? Let's start with that basic. So anybody who has an annual income that's above the basic exemption limit needs to file tax returns, even if after the whole calculation you have zero tax payable. So what is this basic exemption limit? Under the old regime, the basic exemption limit varies according to your age. If you're below 60, it's 2.5 lakhs. If you're between 60 to 80, it's 3 lakhs. And if you're 80 plus, the basic exemption is 5 lakhs, which means if you are total income below this, you don't need to file tax returns. The moment you go above this, you got to file. Under the new regime, everybody, irrespective of age, has a basic limit of 3 lakhs. Apart from this, if you have bank deposits in excess of 50 lakhs, if you have a professional income of more than 10 lakhs, if you pay electricity bills over 1 lakh per annum, or if you are subject to TDS, which is tax collected at source, or tax deducted at source of 25,000 per annum, or if you have income from foreign assets, or if you have incurred foreign travel expenses exceeding 2 lakhs, it makes you liable to file your tax returns. Else, you could be subject to a tax notice. So how do we file returns? The Indian government and the tax department has various forms that are prescribed for various people who need to file returns. So let's have a look at this. So we have the basic ITR1, which means this is for anyone who's an individual, has salary income, has income from one property, as rental from one house property, has family pension or agricultural income up to 5,000, or other sources of income, which could be like interest or etc. But all of this put together is less than 50 lakhs. Then you file ITR1. Whatever we mentioned at the ITR1, along with that, if you have capital gains from either equity, shares or mutual funds or sale of property, then you move to ITR2. You also move to ITR2 if you have any foreign assets or foreign income, or if all your income put together is above 50 lakhs. Then we have the ITR3, which is for individuals and the Karta of the Hindu undivided family. Here, all income that comes under ITR2. And then additionally, if you have income from business or profession, or you are a partner in a firm, or you hold a directorship in a company, or you are holding unlisted equity shares, that mandates that you file ITR3. Then we have ITR4, which is also valid for individuals and HUFs, but their total income should be less than 50 lakhs. So every income that's an ITR3, but the total is below 50. And they could have also opted for presumptive income. That is, you assume that in a financial year, you will have income of X amount, and you start paying in taxes according to that. So these are the basic four ITR forms that are applicable to individuals and HURs. The others are applicable to different other categories which don't come under the individual person. Now, if these are the various ITRs, what applies to whom and how do you choose? So, giving some examples here, we have Arav, who is a software engineer. His income from salary is 7 lakhs. He holds investments in mutual funds worth 1 lakh, and his status is a resident Indian. So, he files the ITR 1. We have another example, Sanvi, she's a physics teacher. Her income from salary is 10 lakhs. But in that same financial year, she also has a capital gain of 2 lakhs from selling shares. So therefore, it makes her liable to file ITR 2 because of the capital gain component. Then we have Priya, who's a homemaker, who has a rental income of 20,000 per month. So she stays below the basic income exemption. And it's not necessary for her to file ITRs because her total income is below the basic level. Then we have Aditya, who's a lawyer. So this income gets categorized as income from business or profession. The income is 24 lakhs and has not opted for presumptive tax and therefore files ITR 3 because this is income from profession. Then we have Neela, who is a freelance content creator, and her income gets categorized as income from business or profession. Her total income from that is about 38 lakhs, but she has extra income of 15 lakhs from other sources, which could be things like interest from her savings bank, from her FDs, or dividend from her shares, or rent, etc. All of that is another 15 lakhs, which makes her total income 53 lakhs, which brings her above the limit of 50 lakhs. And hence, she needs to file ITR 2. Though her income is from profession and business, but because her total income is above 50, she files ITR 2. Then we have Rajesh, who is a loss-making F&O trader, so no income, but has had F&O of minus 2 lakhs, but has to file ITR 3 as income from business and profession because he has made transactions in the financial market and those get reported under your PAN. So therefore, even if there is no tax liable to be paid, ITR needs to be filed under ITR 3. Then we have an interesting case where Kavya is a non-resident NRI, but has rental income of 1 lakh and has capital gains of 2 lakhs. But she thinks that as an NRI, she's not liable to file ITR. Yes, as an NRI, you do not need to file. But however, if you file ITRs every year, it would be useful when it comes at a time of property sale. Also, NRI's capital gains are subject to TDS, and that tax on her capital gain will be deducted while redemption, and she will need to file her tax return to get that extra tax back, which she may not be liable to pay. But if she doesn't file thinking she's an NRI, then those extra tax deducted will not be refunded. So now we all know that over the last couple of years, there have been two income tax regimes that have been announced. One can continue with the old one, or the new one has become the default tax regime. So what's the difference between these two? If we look at the basic exemption, which I explained earlier, there is a difference between the basic exemption between the old and new. Different age groups have different exemptions. And if your total income is below 5 lakhs, this nil tax. While in the new regime, if your income is below 3, that's the basic exemption. But even if your income is between 3 and less than 7, you got to file your tax returns, but it is nil tax. There is a standard deduction exemption for all salaried class under both categories, which is equal to 50,000. Under the old regime, you have the tax exemption of ETC, which has various instruments like PPF, EPF, housing loan principal, insurance premium, etc., with a total of 1,50,000. Another exemption is the interest on home loan, which is up to 2 lakh per year. You also have an option of declaring rent as what you pay against the HRA that you have on your gross income as an exemption, and the tax benefit you get there is according to your eligibility calculation. You also get the exemption for a health insurance that you pay, which is 25,000 for self and family, and a max of 50,000 if you pay for your parents who are above the age of 60. The NPS contribution that you do as an individual is eligible for a 50,000 rebate under old tax regime, but none under the new. But the NPS that you get as from your employer, which is subject to a max of 10% of basic, that exemption is available under both regimes. So one has to look into the entire calculation on your income before you decide which one to choose. So old versus new, and do they also have different tax slabs? Yes. So that's where the difference between the old and new is very critical. You need to evaluate yourself on the old as well as on the new before you choose and declare. So the old regime has 3 tax slabs. There's a basic exemption of 2.5. Beyond that, 2.5 to 5 is taxed at 5%. Then the next 5 lakhs, which is 5 lakh to 10 lakh, is taxed at 20%. And then above 10 lakhs, everything is taxed at 30%. While in the new regime, you have a basic exemption of 3 lakhs. After that, every slab of 3 lakhs is taxed at 3 to 6 is taxed at 5%. The next 6 to 9 is at 10%. The next 3 is at 15%. Then 12 lakhs to 15 is at 20%. And income above 15 lakhs is taxed at 30%. So since you can see different tax slabs in the new regime, some income categories would benefit from continuing with the new regime, even if it doesn't offer any kind of tax exemption. Of course, beyond all this, an additional 4% of cess is applicable on the total tax that you're eligible to pay under both regimes. So make the choice between the old and new regime after understanding your tax implications under both slabs. Apart from the tax slabs and the percentage of tax applicable at each slab, there is another tax implication called the surcharge, which is applicable at higher income slabs. So what does this mean? Anybody who has an annual total income below 50 lakhs does not pay any surcharge and is subject to only the max tax slab. So if your income is below 50 lakhs, you have no surcharge. You only pay any additional income that you earn within 50 lakhs has a tax implication of 30% on the top bracket, another 4% on cess, and therefore any additional income that you earn below 50 lakhs is taxed at 31.2%. For any income that's above 50 lakhs to 1 crore, there is a 10% surcharge in both the old and the new. What does this mean? So any income that you earn when you are above 50 lakhs, firstly, the income gets taxed at 30% because that's the max slab. Then there's an additional 10% surcharge. And then there is a 4% cess. So in total, in 100 rupees that you earn above 50 lakhs, 34 rupees 32 paise is out as tax. When your slab total income is at a 1 crore plus 1 to 2 crore, there's a 15% surcharge under both regimes. So here what happens? 30% plus 15% plus 4%. That makes it almost 36% of tax on every 100 rupees that you earn above 1 crore. If you are in the slab between 2 to 5 crores, There's a 25% surcharge in both regimes, which makes it 30%, 25% plus 4%. So that's a total of 39%. So anybody who earns additional money between 2 to 5 crores, 100 rupees minus 39 rupees. That's how it works. Once you're in the slab above 5 crores, the old regime has a 37% surcharge, while the new regime sticks with 25%. So if you're in the more than 5 crore tax slab in the new regime, you're still only at 39%. While if you're in the old regime, you're 30% plus 37% plus 4%, which works out to a total of almost 43% of tax on additional income above 5 crores. So this is the impact of the higher slabs of income. And there are ways and means as to how to avoid this excess surcharge or reduce this excess surcharge by ensuring that any kind of additional source of income you do thoughtfully. While our salary is subject to tax and we can't do nothing much about it, we can always look at how to ensure that the other sources of income or other investments that we make reduce this additional income that comes in, which can push you above the tax slab. So, other incidental income can push you to a higher tax slab, and that's where we need to be careful about how we manage our savings and investments. So, how do we do that? Incidental income that you can possibly avoid, ensure that you don't jump the tax slab, is rental income. Because rental income adds to your total income and pushes you above the tax slab, and then all income will be taxed at the higher level. Interest from deposits can push you above the tax slab, and income from dividend on shares can also push you above the tax slab. So, what is the solution for something like this? Long-term equity mutual funds have a low tax implication on the gains. Here, your money is invested, and as long as it stays invested, there is no gains involved. There are gains, but no capital gains involved unless you take them out. So, tax on capital gains comes only after you redeem, not while it stays invested. And even there, it's taxed at a flat rate of 10% and hence not taxed at slab rate. Debt funds or debt mutual funds, where the growth is not taxed till you withdraw, which helps the value to accrue better without being taxed at an immediate basis. Unlike your FDs, where you're immediately paid, once the interest is paid out, you're taxed and you're added to your income. We all know that over the next few years, all those who are in the growth trajectory of their career, the salary income will go into higher slabs. What we should be mindful is do not add instruments that will push you to a higher slab unnecessarily. Because in future, post-retirement, our tax slabs will anyway be lower because our income levels will be low. At that stage, an additional income would maybe be a consideration you can do, because then pushing you up the tax slab or higher tax slab into surcharge may not happen. Apart from this, there are ways in which we can reduce tax implications on us, not by avoiding tax, that's not something we can do, but we can avoid penalty or interest on tax. So, what's the first point? File your tax returns on time to avoid a penalty of 5,000 rupees, which can be charged on individuals who file their tax returns after July 31st. So if you have income which you do not need to get it audited, please file by 31st July. If your income needs to be audited for any particular reason, like it's business income from business and profession of a certain level, then your last date of filing is 31st October. Please file before these dates to ensure you don't pay that additional 5,000. Also, you need to avoid interest on tax that is payable as advance tax. Any capital gains that you receive, any additional income that you receive is subject to advance tax. And advance tax means by the timelines that are specified for each time slot, you got to pay in that percentage of tax by those due dates. And these due dates are 15th of June, the first one, which went last month. By the 15th of June, whatever tax you have incurred, you got to pay 15% of that. By 15th of September, you got to pay 45% of the tax that you have already incurred for the income so far. By 15th December, you got to pay 75%. And by 15th March of the financial year, you got to pay 100% of all tax that is payable for you in that financial year. Now, they give you these 3 or 4 slabs because they don't want you to pay up 100% of what is due in June, because in the following months, there could be some adjustment. So that's why there is a breakup of how much is due in each quarter. And then by the end of March, you need to pay in 100% of that tax. Now, if you do not pay the percentage that is required to be paid in by these months, you start incurring interest at the rate of almost 1% for every month that you have missed. And that adds to your total tax outflow when you file your returns. It's very easy for a CA to tell you, ha, madam, sab theek hai, all is fine. We will file your returns on the day, and whatever tax is payable on that day, we will pay. Unfortunately, interest also will accrue till then. So kindly pay up advance tax and file returns. Ensure you pay the minimum tax that you have. Then we have some different tax statements that the government shares with you. One of them is called the Form 26AS. What does this give you? This shows details of tax deducted at source, which could be tax deducted on your salary, tax deducted on interest, tax deducted on dividends, or any TDS on any professional fees that you have charged as part of your work. Then there's tax collected at source, or TCS, which is deducted when you make any kind of overseas payments for travel or overseas transfer of money to any family members. Then there's details of tax collected on the sale of immovable property above 50 lakhs or on sale of immovable property by NRIs. It's mandated that tax has to be deducted if the property sale value is above 50 lakhs for the resident individual and for any NRI. Then there is details of advance tax. I just mentioned that you got to pay advance tax. So all the advance tax that you have paid will show up over here. You also have the option of saying that I would be incurring this much of income over the year, and therefore I start paying some amount of tax. So self-assessment tax as well. So this could be salary deduction, advance tax on capital gains, estimated income, etc. And it would also give you turnover details as reported by your GST statement. So you can download this Form 26AS from the ITR website, the incometax.gov.in, using your login with your PAN number, and you can download this form to check details. Apart from this, there are 2 other statements that are shared on the income tax portal, which is called the TIS and the AIS. So the TIS is the tax information statement, and the AIS is the annual information statement. So what does the tax information summary statement show? This is something that you can download from the website. So it will show you your permanent account number, your Aadhaar number, your name, date of birth, mobile number, address, etc. And below, it will list out the various parameters which are applicable to your PAN number for information that has been captured. So it could be your salary, it could be a dividend, it could be interest from savings deposit, bank, interest from bank deposits, sale in purchase of securities and mutual fund, and any kind of FDs that you have put money in. Now, this will give you a summary number. So it will give you a salary, 25 lakhs, dividend, 5 lakhs, interest from savings bank 20,000, interest from deposits 1 lakh, sale and purchase of mutual funds say 3 lakhs. It will give you the summary value. Beyond that, when you look into the annual information statement, this will give you a more comprehensive view of this in TIS. It will include the details of each of these transactions. So if in the TIS you say salary 25 lakhs, in the AIS you will have the month-on-month breakup as well as the tax deducted details. This is information that the government is capturing based on everything connected to your PAN number. When you file your tax returns, it is your responsibility to check whether this information is right or wrong. Accept the right. You can question what is not correct and show it as an error. And basis this is how you need to file your ITR. A sample of TDS. So this is from dividend from shares. So it will show you the various companies that have paid you dividends over the year. It will show you the various savings bank accounts on which you have received interest. It will show you the fixed deposits on which you have gained interest. It will show you your various transactions with respect to shares or mutual funds, the purchase or the sale. Additionally, it will also give you the advanced tax payments that you have made. It will show the advanced tax, the self-assessment tax, etc., that you have paid in that financial year. Now, after all of this, when one is filing the ITR, people say, I did all of this, but I still got a tax notice from the income tax authorities. Now, why does that happen? Now, common reasons for notices from the income tax department is because it's a mismatch in reported income. You have the captured data at the back, which I showed you, does not match with the data that you have reported. Or you have not disclosed foreign assets or income, or there is incomplete or incorrect information. How to avoid this? Report all income accurately, disclose foreign assets and income, and keep a record and a documentation. This will save you a lot of heartburn from receiving income tax notices. Of course, in spite of that, if it does come in, there are ways and means to treat it. You can raise a complaint, a grievance, or you can file a revised return. Why do you need to report assets outside India? It's mandatory against the Black Money Act, and it includes bank accounts, financial assets, and properties. And if you do not report, then it's non-compliance to the rules and could impact with heavy fines or even legal consequences. You also need to report foreign travel. Another reason why income tax notices happen, because when you incur foreign travel expenses, it means that you have it's an indicator of your financial capability, and hence it needs to be reported. And it also helps in tax assessment and avoiding any kind of scrutiny. Because if you've traveled and you have not reported, then there is a chance to trying to find out why did you not report it, and then the scrutiny starts. What do you need to provide? You need to provide total expenditure, the purpose of travel, and the duration of travel. A lot of people then say, every month is fine, but in February and March, I get a huge tax TDS. How can I avoid that? So why does this happen? This is because of year-end adjustments for the total salary and other variable pays that are paid out. And then it has to be adjusted so that before 31st March, all the tax for that financial year needs to be paid. And this is because the finalization happens at the last minute based on what you had declared as tax-saving investments and what was actually made, and a mismatch between the two. So how do you avoid this? Declare your choice of tax income at the start of the financial year. Declare all investments and tax-saving instruments early to your employer, and regularly update them if you have any kind of change in your last minute details. I hope this session was informative, and we now open up to questions that you could have. You could drop your questions on the chat box, or you could unmute yourself and also ask a question. Okay, I can't see who this is, but the question says, how do we check if the tax liability that is calculated on the IT portal is right, especially for the additional income from other sources? Well, I just shared the various tax slabs and the various implications on the additional income that you earn. So you would have to look into that. And when you look at the portal actually shows you what is the tax liability for each element. So, and there are many external tax calculators as well. So you could use one of them to check that. Thanks for taking out time on a Saturday morning to join us for our session today. If we do not have any further questions, then I'd like to close the session today. And we will let you know if we are having a second session. We will send you the invite, and do drop us a message on our numbers or on our website. If you have any feedback on the session, be nice and help us to improve our next session. Thank you so much and wish you all a nice weekend.